is Fahim, and I have today Adam Stapley from Pineapple Financials. Thanks for joining us today.
Thanks, Fahim. Really appreciate you having me out here today.
Thank you, of course. So, as you know, yesterday interest rate hike. So, a lot of questions in the market from the buyers and the sellers in terms of the interest rate. So, can you tell us more about what's going on in the market in terms of the interest rate?
Absolutely. So yesterday, the Bank of Canada raised their overnight lending rate by 0.5%. This is to help them bring down inflation, which is currently at record highs. Now, it's something that's happening around the world. Central banks around the world are increasing their interest rates, and Bank of Canada was actually anticipating, or we were anticipating, I should say, a 0.75% increase. So this is actually on the smaller end of what we had expected them to do. This will impact your variable rate mortgages, as well as home equity lines of credit, personal lines of credit, and even some car loans. Basically, any loan that you have an interest rate that is prime minus or prime plus some sort of pricing. So if you have a home loan at prime minus 0.55, your interest rate will go from 4.9 up to about 5.4%. Just so you know where that puts you on payments. If you have a mortgage with $600,000 outstanding, for a 0.5% increase, that's about $30 for every $100,000 outstanding balance. So on a $600,000 mortgage, you're probably going to see your monthly payment go up by about $180 next month.
Mm-hmm. Okay. All right. So why the interest rate is so important?
Yeah, so interest rate is very important because obviously it affects your monthly payment and the overall cost for the loan. Now, there's a lot of other factors that go into a mortgage, and interest rate is definitely important amongst those. As long as everything else is equal, then we start to look at, okay, what is the lowest interest rate? Because when you're paying a higher amount of interest, it means a larger portion of your monthly payment goes towards the lender. It means the loan is more costly. It also means your overall payment is higher than if the interest rate were lower. But importantly as well, because your mortgage payment is made up of both interest and principal, the higher the interest portion, the smaller the principal portion. That principal portion is going back to pay down your mortgage. It's kind of like a forced savings plan, which builds equity within your home, which builds your wealth for your financial future. So the lower the interest rate, the more principal you're putting back towards paying down that mortgage. So interest rate can be very important on your overall financial situation.
Mm-hmm. So I get like this question all the time. What is the difference between the fixed mortgages or the variable mortgage? What are their pros and cons? So which one the buyers they should go for that product?
Yeah, obviously a very important question to be asking. We get this a lot as well. There is no one size fits all answer to what is best. First off, the difference, right? What is the variable rate? Well, the most variable rates in Canada are what we call an adjustable rate. That means with yesterday's Bank of Canada announcement, with interest rates going up 0.5%, it means your interest rate goes up, but so does your payment. Your monthly payment will adjust and be higher next month. With a fixed rate, you know from day one throughout the rest of your term what your payment is going to be, and your payment will not change. Your interest rate will not change because it's fixed for the duration of your term. Now, your mortgage term may be anywhere from 1 to as long as 10 years, and throughout that period, you know exactly what your monthly payments are. Now, which one Canadians should be choosing? It's really going to come down to each person's individual financial situation as well as their tolerance for risk, right? Some things you want to consider is how long are you going to be in that home? What are your goals for that property? Are you going to need to take equity out of that property? Maybe break the mortgage early. If you're going to break the mortgage early, we might want to consider looking at variable rates. They're a little bit cheaper. They save Canadians more money. They have lower prepayment penalties. You're going to be in that home a long period of time, and your budget doesn't have the capacity to absorb fluctuations in mortgage payments. Then maybe we want to look at a fixed payment to make sure that your payment doesn't change throughout the lifetime of your loan. Traditionally, variable rates have saved Canadians money versus fixed rates. They do that through lower prepayment penalties. Prepayment penalty is when you pay off a mortgage in full early, which can happen when you sell the property, when you refinance the property, or if you have an inheritance that helps you pay off the mortgage. You will have a lower penalty with the variable rate than the fixed rates. Variable rates are also typically priced a little bit lower than fixed rates, but that interest rate can fluctuate throughout the term. At the end of the day, I think risk tolerance is the number one factor for me. I like to ask all of my clients, if your monthly payment were to change overnight, would that keep you up at night? And if you think that you'd be stressed out thinking about your monthly payment and its fluctuation, no matter what your financial circumstances are, then it always makes sense to go with a fixed rate to gain that peace of mind to ensure that you don't have to worry about your finances throughout your lifetime in that home.
Mm-hmm. Okay, all right. So, what do you advise you give it to the sellers who are actually in the renewal process, or their term is going to over soon? So, which product should they choose, fixed or variable?
Yeah, again, this is really going to come down to the individual situation. This is part of the reason why we start our renewal process. Considering renewals, usually at around 8 months. Right now, with the rising interest rates, we're starting that with most clients about 12 to 18 months in advance. This gives us an idea of what we should do at renewal, whether we should renew early, take advantage of lower interest rates before they continue rising. If somebody's thinking of selling their home and they're also coming up to renewal, you're going to have to think about, okay, when are you actually going to sell the home and when are you going to close the home? You might want to be considering shorter term fixed rates, such as a year or even 6 months. You might want to consider a variable rate. It will give you a little bit of flexibility. Maybe you're not going to sell for the next 6 to 12 months, but you do want to lower that penalty and have a lower exit cost on that mortgage. Then looking at a variable rate might be the best way to do that. Or if you're thinking of selling and closing within the next 3 to 6 months, quite often looking at an open term, which will have a much higher interest rate. However, because it's an open mortgage, there's no penalty on the exit when you sell. That way, you can actually protect yourself and probably save yourself more money by paying the higher cost today and saving money when you sell and close that home. So there's a number of different considerations to make, but kind of taking a look at what your long-term situation is or what your short-term needs are when it comes to the sale of your home, really going to be important to that renewal decision.
Thank you so much, Adam. So I think this information is going to be helpful for everybody. So thank you so much.
No worries. Thank you very much, Maheen. You have a great rest of your day.
You too. Bye-bye.